Hello, welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I will be your host for about the next 20 minutes here. Today's date is Wednesday, March 6th. The markets are open and they are rocking and rolling. They're really rocking and rolling right now because Fed Chair Mr. Powell is speaking, and one of the things that Mr. Powell brought up is that he said that it is likely that we will see a lowering of the Fed funds rate. And the word likely was taken very positively in the markets, and the markets have basically jumped since he started talking. Right now, we have the S&P 500 index at 5115. It is up 36.47 on the day. That's about 0.75%. So strong move to the upside in a weak marketplace. The marketplace has been weak, just recently showing a little bit of weakness in general. A little bit to do with with Apple and what's going on with the lawsuits in Apple from the EU. It's hard for the market to make a strong move to the upside without Apple participating. It did pretty well. It stayed fairly flat, but Apple is down about 10 points since that news, and it is still struggling today. We see that Apple is actually down. If I look at it real quick, like it's down 43 cents on the day. It's trading at 169.66 at this point in time. So even in the up market, Apple is still struggling to go up. A lot of the other magnificent sevens, including Google. Google's actually getting beat up a little bit too. But of course, we have the fan favorite, NVIDIA. NVIDIA is up another 25 points today, or 2.8%. It's trading just shy of 900 at 884. So we actually, in our paper trading account, sold a call option that was around the 850 level, and we got fairly lucky in that it expired on last Friday, because the marketplace has been really strong in it. So we did very well with our deep in the money call options on NVIDIA. We put those on. We put a couple on in November of last year, and then added to that position. So that has definitely worked out for us. And after this week, we're going to go back and look a little bit more at that paper trading portfolio. In NVIDIA, I really don't want to sell any calls. The market's just too strong. The limitation on the upside isn't worth that risk. So with selling calls on a deep in the money call option position, you're looking at opportunity cost. And I think the opportunity cost is too high in that underlying stock. So we also even have the Russell 2000 index up almost 0.8%. So we did talk about the fact that if the Russell can establish some upside, and that it's actually broken out of the channel, that it might be a long call play. And I still think that factored in, and definitely after Chairman Powell's comments today, if we do get an interest rate cut, the Russell 2000 index should be a big benefactor in that. All the small caps in general should be a big benefactor if we can get that. If that holds true. Obviously, there's always the stipulation that we're going to check the data and make sure that inflation is still coming down. So it's always said with the disclaimer when Chairman Powell is talking. So I went back and looked at Friday's show with Dan Sheridan, and I wrote down the trade that we were looking at Friday's show and the total cost. And then we looked at Monday's show, and we took my screenshot, decided that we were going to do a paper trade and just a long calendar trade in the SPX. So we're going to jump over the TradeHawk software, and I have all the trades loaded up in the what if calculator, but we're going to start by looking at the chart in the S&P 500 index. And so if we go back to Monday, so today is the 6th, Monday was the 4th. That's when we were looking at putting on the trade. So the market, most of the day was just kind of boring, right? Right around the 51.30 level. That's where a lot of the volume was at. Market didn't fluctuate too much. We then had a down day the very next day, and that probably had a little bit to do with Apple. Apple went down 5 and then continued on down, but the market just in general was showing a little bit of weakness. And that's, markets don't have a tendency to go straight up. So there was no harm in that fact. It looks like the 20-day moving average is providing some support on it. And the market came down to our short strike. Right there, this is where our strike was 51.90. If you can see that, if you zoom in on this trade, 51.90 is where our strike was at, and that's where we wanted the market to go to. I did look at the trade. I didn't get it right when it was right at 50.91. The market had gone down a little bit further, and that trade was up a few dollars at that point in time. So definitely would have taken it off. We put that entire trade on for $11, and it was trading at one point in time. You probably could have got out for about $14 or $15 on that trade, somewhere in that range. When I looked at it, the market had came down, and it was trading right around here, right around 50.76. Actually, I think it was around 67. Yeah, right in that range. It was on the tail of this candle, right around here. And the calendar spread that we initiated on Monday was then trading for around $13. So you would have been up $2 on the trade. You still would have had the long call spread and 4 or 5 days to trade that long call spread. Not to mention the fact that that's on Dan's side of things. On our paper trade on Monday, we just looked at one put calendar spread. So it was positive because the market made the strong move to the downside. And you're also nervous because if the market keeps going that way, it's going to hurt you tremendously, because what will happen with the option contracts is the shorter term option contract will move quicker against you than the longer term option contract. It will have a higher delta once it gets in the money. So let's go in and look at that trade, and let's start with that trade, because now the market is coming back strong. And if the trend is your friend today, it looks like it's going to probably even close higher going into the close. Obviously, we're not watching what Chairman Powell is saying at this point in time, but based off of his opening comments, it's been good for the market. Straightforward. All right, so I'm going to run over to trading. This is the trade that we had on. I'm sending it to the what if calculator. And this is where we're at right now. So the market right now is at 51.16. If we put the trade on currently, let's see where it's trading at. Oh, we need to put side of things. There we go. It's currently trading at 15.10. So that's interesting. So the market came all the way back up. And let's send that to the what if calculator. That's going to work a little bit better. Just a lot less expensive option contracts. The profit and loss graph would still look the same. But let's look at this. This is the call. We're going to take this trade out of here, and we're going to look at the put side of things. And based off of just time decay, and also the market has gone down. So when we put this trade on, what we did is we looked at the 50-90 puts, and we are here in this is the March 15th expiration. And then we looked at the March 8th expiration, 50-90 puts, right? So we got the 8th, and we got the 15th, which is 9 days away. And if we scroll down to the bottom here, that is now trading for $15.10. When we put the trade on, we did this trade for a net debit of $11 to the account, and the market was at 51.34. 51.34. Right now we're at 51.17. So we have moved in the positive direction. We've had 2 solid days of decay with the option contracts, and the market has came back. Now, there were many opportunities between Monday and Wednesday to trade somewhere around our target, which is 50.90. So there might have been opportunities even on the way back to try to get out of the trade at a higher price. But the biggest thing about the time spread and the calendar spread, or however you want to, what vernacular you want to use to describe it, is time decay. We want every day that goes by in a weekly SPX option is very high rate of time decay, because these are still very expensive option contracts, right? 50.90, this is out of the money. It's quite a bit out of the money. You're talking about 25 points out of the money on this option contract, and this put option is still trading for $27. So from Wednesday to Thursday, there's going to be another big, Wednesday to Thursday, yes. There will be a big chunk of time decay. And this is when the option contracts and the SPX really start decaying hard. And then obviously on Friday, if they're out of the money, all the time premium has to go away. But SPX options have a tendency to hold their time premium until we get closer to expiration. And this, by my definition, is closer to expiration, the Wednesday to Thursday. So if the market wasn't in this positive upside trend, I would consider looking at staying one more day. I think the market's too strong based off of the comments from Chairman Powell. So I would want to get out of the trade today. I would have gotten out of it on Tuesday, mainly because if the market just kept going on down, which I was a little bit nervous about anyways, I think the path of least resistance, when I started the week, my attitude was more so to the downside than to the upside. So I would have removed that position. Now the market is back. It's trading for $15. That's nothing to sneeze at. We put it on for $11. We're up about $4 on that trade. If the market continued on up, the roll here would be to actually take the short option contract, which would be the March 8th expiration, and actually roll this up. So you have the long contract that's helping you, but you could roll into a diagonal spread if you wanted to. You could buy to close this one and sell to open one of these if the market continued on up. Or you can actually roll to the next expiration, the long expiration, which is the 9th. You could roll it, buy to close the March 8th and sell something on March 15th. So I'm going to set that up just because I do think that that's a interesting roll that you could do in the trade. There's no reason to do it right now, but I'm going to just show you what that would look like. So we have the 50.90 in here, and this right now is on our order ticket down below, 50.90. This is the put that we sold. So here you would be buying to close. I'm just going to click buy, and then you're going to sell to open a new put. So this would be buy to close, and this would be sell to open. And the strike that we'd want is to go up a little bit higher. So, and it's all about the risk here. So if we do the 90.95 strike, that option contract means that we would have 5 points of risk, or we could do the 5100, which would be 10 points of risk. Our total risk on this trade was $11 to start with, so I think I would keep it there. I would look at 10 points wide, which is $1,000 in risk, and I would sell that option contract. All right, so if you did that, I want to make sure that this moves. So you're buying to close, selling to open. You would be bringing in a net credit of $18.55 to the account. So not a bad roll if you wanted to do it. Right now, the trade is profitable, but if you did that trade to adjust your position, the market would be much higher than it is right now, and it would be running away from you, and you wouldn't get as much of a credit, but that would be the roll that you would look at doing, quite simply. So that's the adjustment on a trade that we basically don't need to adjust. Okay, so if you have any questions or comments, please do put them in the chat box. If you're on the Tradier YouTube platform, I can try to address them. Just toss them in the chat box. And if there aren't any questions on this trade, this is our first time doing an SPX calendar. We've looked at other calendars before, but this is our first time doing an SPX calendar. And we got introduced to this by Dan Sheridan. On last Friday's show, we had a nice long conversation with a good friend of mine, Dan Sheridan from Sheridan Options Mentoring. And he talked about doing a double, I don't even know what I would call it. I should ask him the name of it. Instead of it's not a double butterfly, it would be a long calendar and a long butterfly. So here's the way he had that trade set up. And I went into the what if calculator. And when we were on the show, I was struggling a little bit, and it has to do with the roots. The SPXW is definitely different than the SPX. And the calendar that we looked at, okay, this is the setup. This is the way Dan had the trade set up. So I'm going to pull this up, and we're going to look a little closer on it. So this is as of today if you establish the position. Market's at 51.18, 51.18. That's where the last trade was at. When Dan was on the show, the market was trading at 51.16. Interesting. All right. So the market is back to where it was at that point in time. The entire trade was put on for $5.50. The calendar was set up a little differently. Dan sold the Friday expiration and bought the Monday. So the market was up a little bit more when we did it. So we were a little bit higher up in our strike. But in Dan's scenario, he did the 50.85, which is 5 points below what we were looking at. And if we look at these two, let's send that to the trade ticket. The market's right where it's at. So this will be very interesting. Is right where it was trading at. Okay. So that trade, the midpoint of that trade was $2.30. So because of time decay by itself, so this is a great example of just time decay. The market's at 51.18. The market was at 51.16. So it's only 2 points higher approximately. And based off of the time decay, so that higher means that's bad for our long calendar, right? We want it to come back down towards the strike. So obviously on Tuesday, there would have been a good opportunity to get out of the trade. Once again, much the same as my paper trade that I put on in the SPX. But with that said, right now, this is very interesting in that the market is about where it was at. And based off of time decay alone, the midpoint now is $3.10. So you're up 80 cents on this side of the trade just from time decay. And well, VIX might have got a little bit of a pop, which might have helped out our trade a little bit here too. But mainly from time decay of the short option contract, the 50.85, this position is up 80 cents on the trade. Might be 85, somewhere within that range, 80, 85 cents. So you would just stay the course here in my mind, because we have both sides of the trade. If we go back to the what if calculator, this is the put side of things. If the market continues on down, that is going to be a benefactor. And then here's the call side of things. If the market continues on up, we're still trading right at the midpoint, right at the middle here. So there is a point where it hurts a little bit, but as it goes, this line, which is as of today, will start morphing towards the middle of our long call spread. So we're looking extremely good on this trade. If you wanted to speculate on direction, you could close out the put side of things. You could do that. You could take that off if you wanted to. But right now, we're in this area of flux where if the market goes back down towards our short strike, we're good. And if it goes towards our long strike, we're also good. And it is Wednesday. So I don't mind hanging in this trade right now, even though you probably have a profit on it. Let's look what's going on the call side of things. So let's uncheck these boxes if it will allow me to. And we'll put the call side in. There we go. Send to ticket. Let's hope this makes it there. There we go. All right. So that was put on the call side of things. That was put on for $3.20. $3.20. And the market right now is, well, 385. Okay. So this trade is also doing well based off of time decay. March 8th. Okay. 51.25. Yeah. So that's $3.85 right now. Market's moved up a little bit. We definitely need this one to move up. We want to get to the 51.25 strike. That's really important on the call side, and the butterfly want to be inside the wings of the butterfly. So not bad. I like where the market is at. I think it's going to be a very interesting Friday to see how this trade all works out. As of right now, Dan Sheridan, I guess you could say, picked a winner in the paper trading world. So two very interesting trades that have been put on this week, and I think we're just going to let it ride. So if you do have some questions, because there is a lot to cover here, I'm going to go back to the what if calculator and highlight. I'll remove these just to get rid of the noise. One more. There we go. All right. So this is the call position. This is the put position that Dan talked about. Highlighting here that we're selling the put with the same expirations as a call, and we're buying the Monday put, and that has a different expiration date. The plan would be to take this entire trade off and not just get long the put going into the weekend. If you do that, you are speculating on the put buy. You're putting on this trade on a weekly basis, hoping that if the market just stays here, you can take this all off and have a decent credit on a percentage basis. The long butterfly trade, the risk is just the long butterfly. So the risk on that trade was $3.20. On the put butterfly trade, the risk was $2.30, the net debit paid. So they both are limited risk positions. And yeah, this is where we ended up at. So a very good week to put this trade on so far. Would have been an opportunity. In my mind, we probably would have been out on this side. We probably would have closed it for a bigger net credit to the account, and then have a possibility of this butterfly actually paying out on the upside. All right. And if you wanted to screenshot that, there you go. I'll leave that available. And then I'm going to run over to my time spread, which is 50.90. No, that's the call side of things. Okay, here's the put side of things. Okay. So right here, this is that calendar. Market last trade is at 51.18. It's right here. Our point that we'd like it to come down to is 50.90. This is as of today, and we can move it forward. Let's do that. Let's move it to Let's go jump all the way to Friday, and it would be 11 o'clock on Friday. And boom, look at what happened with our profit and loss graph just from 2 days worth of time decay. Quite a bit, right? And if the market stayed where it's at, this is where our profit would be at, approximately. Now, this is assuming you put the trade on today, but this is the graph would look very nice if the market just stayed in this area and we got the huge rate of time decay on the shorter term option contract. All right, well, that's going to be it for this edition of Options Guy TV. Please come back Friday, 11 a.m. Eastern time. If you are on the Tradier YouTube platform, you can ring the bell. You can click the thumbs up and ring the bell so you get all of the alerts for the next edition of Options Guy TV. And these trades will be very interesting to check out on Friday to see where we end up at. And then next week, we'll start looking a little bit more into the long-term portfolio as we get into the summer months inside the TradeHawk paper trading app. Thanks for coming.
All opinions expressed by Tradier Hub contributors are solely the contributors' opinions and do not reflect the opinions of Tradier nor its affiliates and or subsidiaries. You should not treat any opinion expressed by Hub contributors as a specific inducement to make a particular investment or to follow a particular strategy, but only as an expression of their opinion. The contributors' opinions are based on their own personal research, but neither Tradier nor its affiliates and or subsidiaries warrants its completeness or accuracy, and it should not be relied upon as such. Any trades or positions discussed or referred to by contributors may or may not be actual live trades or positions. Such information is not intended to be financial or investment advice. Tradier Inc. is the parent company of Tradier Brokerage Inc. Tradier Brokerage Inc. and Tradier Inc. are separate entities with their own products and services. Securities products and services are offered through Tradier Brokerage Inc. Tradier Brokerage Inc. is an independent subsidiary of Tradier Inc., all rights reserved, member FINRA SIPC.